Welcome everyone. Thank you for attending today's webinar. Today we will be talking about marketing. The title of today's webinar series is titled Spotlight Your Brand. My name is Anthony Aluzzi. I am a client relationship consultant here at Capsim. Questions will be addressed at the end of the webinar. So today it's going to be 15 and 15. So 15 minutes for the content of marketing and then 15 minutes to answer any questions pertaining to marketing. If you have any industry-specific questions, please don't hesitate to contact us on our support line. We have a staff dedicated to answering your questions. We can be reached by phone, toll-free, 877-477-8787. And we can also be reached by email at support@capsim.com. Please keep in mind that today's webinar will be recorded and placed on our website, so no need to take notes if you don't want. Without further ado, we will jump right into it. So this page is the course page. This page should be familiar to you. One thing I also want to mention today is that for the sake of the discussion, we will be discussing Capstone as opposed to Foundation. And the reason why we're talking about Capstone more so than Foundation is because a majority of our users do use Capstone, and on top of that, when we look at the marketing decision page, I think it's more inclusive for Capstone and Foundation, whereas the other way around, if we're talking only about Foundation, it doesn't apply so much to our Capstone users. So for the sake of today's webinar, we will be using Capstone as the primary tool. If you do have any questions pertaining that might not be covered because they're specific to Foundation, please, again, feel free to give us a call, and we will do our best to help you address those. So the first thing we're going to do is we're going to jump right into Capstone by clicking on the orange icon. So now we're going to go to the decision-making interface, and we're going to talk about marketing. So we're going to select Decisions, and then we're going to launch the web spreadsheet. Notice that there are two versions here. You can open up the web version or the Excel version. Sometimes your instructor might have a preference. Typically here, I think the consensus is that we use the web-based version because there's no downloading involved, and you can jump right into the spreadsheet. So we'll go ahead and click Launch the Web Spreadsheet. Sometimes you might see this option. So this just means that the decisions that are official decisions and your decisions are inconsistent with one another. So it's important to check the actual the timestamp. So you'll notice that the last time I entered the spreadsheet was January 26th, 12:38 p.m. Central Time, which are inconsistent with the official decisions that were saved 10 days ago. So it probably makes more sense for me to jump into the draft decisions, since probably those are more updated, given that those were referenced more recently. So we're going to jump right into the draft decisions. And here we are. We're inside the spreadsheet. So what we're interested in talking about today is marketing. So we're going to go underneath Decisions and select Marketing. So last Thursday, Curtis talked about research and development. Research and development covers one of the 4 P's of marketing. So for you marketing majors out there studying marketing, there are 4 P's in marketing: price, product, promotion, and place. So research and development deals primarily with the product aspect, which is 1/4 of the marketing mix, otherwise known as the 4 P's. The marketing department actually covers the other 3 of those. So we have price, promotion, and sales budget. So you'll notice that there aren't a lot of decisions that can be made directly from the marketing decision spreadsheet page. There's only 4. So you have the price, the promotion budget, the sales budget, and then you're also going to design a forecast. Your forecast essentially answers the question, how many products do I think my company will sell over the course of the year? So I typically recommend that the marketing decisions are done after research and development decisions. That's kind of why they're structured. The spreadsheet is structured this way from the decision drop-down menu. That's also why the webinars are structured this way, because from a marketing perspective, it's kind of important to determine what price you want to associate to your product without having known what attributes you're defining your product with. So if you were with us for the webinar on Thursday, Curtis kind of walked us through how to make some decisions for the research and development department, and now we have the ability to make some decisions for marketing because we know what attributes some of our products might have. So one thing to pay attention to is the customer buying criteria, which we've kind of been mentioning throughout the course of these webinars. The customer buying criteria can be found on the Capstone Career. So underneath the Reports tab, we're going to open that up, and it can be found in a couple places. So what we'll be interested in doing is maybe going to the traditional segment just to open up page 5, and this will show us a deeper dive at what the traditional customers are actually looking for, and this is something that Curtis did point out last time during our webinar. So you'll notice that shown on page 5, the traditional customer buying criteria is in the upper left-hand corner, and we're looking specifically at price right here. So these customers value a price between $20 and $30. Now, looking at our price on the marketing decision page, our price is priced between $28, which is within that range. So the price we have is appropriate. There's some things to be mindful of. So if we're to reduce our price, technically that means that our contribution margin is going to go down, because we're still paying the same amount of money to create this product. And this is kind of what we call breaking the cardinal rule. Oftentimes, if you're trying to compete on price, many students might jump right into it and say, hey, we know that the traditional and the low-end customers really value price. We're going to lower our price down to the bottom of the range. Now, the thought process or the intention is good, but you're actually hurting yourselves. In hindsight, you're hurting yourself simply because lowering your price before lowering your cost of goods sold is actually going to reduce the amount of profit that your company has. So rather than reducing your price immediately, it's important to seek ways to reduce your company's cost structure, some of which will be discussed at the next webinar, or I'm sorry, 2 webinars from now, discussing the production decisions. One of the ways in production to reduce your cost structure is looking into automation. And then one we talked about last week was in R&D was looking at your material costs. So looking to reduce things like mean time before failure to reduce the material costs associated with your product. So it just so happens that I'm relatively satisfied with this price for now because it's within that range. So again, going back to the traditional segment, although these customers do care about price, 23%, they want it within this range. Obviously, there's a higher demand when you go lower, but right now we're within the price range, and I don't want to eat away at my own profits just for the sake of giving my customers a better priced product. I should look for ways to reduce my cost structure in the future so that I can actually offer my customers a better price. So definitely be mindful to the customer buying criteria because this is really one of the keys to the game. It allows students to determine what their customers are looking for when paying attention to the marketing decisions. So that's the second P we've discussed so far in the webinars. We've covered product, we've covered place. The other 2 are going to be impacted again from the marketing decision page. The first is going to be promotion, and the second is going to be place, and we kind of define place as sales budget here. So simply enough, the promo budget actually allows you to improve your awareness. The sales budget allows you to improve your accessibility. So your awareness, as you might be familiar with just being a consumer yourself, is like saying what percentage of customers know my product exists. The sales budget answers a different question. It says, okay, of those customers that know my product exists, how many of which can access my products? How many of which have the ability to obtain my product or interact with my brand via my sales budget? So we have 2 different budgets here, the promo budget and the sales budget. Again, respectively, the promotion budget affects my product awareness, whereas my sales budget actually impacts my entire company's accessibility. So one major difference you'll notice is that the promo budget is by product. The sales budget is actually by segment. So this is helpful. So when our new product, Apple, comes out, we're still going to have to assign a promotion budget because we're promoting our individual product, but our sales distribution channels are kind of impacted directly by our sales budgets. So since this is going to be a high-end product, both the Apple product and the Atom product are actually going to share the same level of awareness, or I'm sorry, the same level of accessibility, since their budgets will be combined together. So again, the main difference here is that promotion budget is by product, and the sales budget is by segment. So if you have 2 products competing in the same segment, both budgets are going to be combined to actually accumulate your sales budget. So some interesting information about these budgets is that you can click on these eyes, and this will actually let you know how to calculate your exact promotion or your exact awareness or your exact accessibility over time, because we know each year your promotion and your awareness are going to decrease by 33%. Depending on how much money you want to allocate to your promotion and sales budgets, you're going to actually add back some of that additional promotion and sales so you can actually drive awareness and drive accessibility. So paying attention to these eyes is actually one way that that you can increase your promotion and your sales so that your product is going to increase. Another decision that we're going to be making in the marketing decision page is the forecast. Now, we acknowledge that forecasting is somewhat challenging. It can be challenging depending on what your strategy is. We have a webinar dedicated to forecasting on Thursday. So again, like I mentioned, your forecast answers the question, how many products you think you're going to sell over the course of the year. You'll notice that everything else on the spreadsheet is an output. So hypothetically, let's say our forecast is 1,000. Keep in mind that everything is in thousands here. So this is like saying, I think I might sell 1 million products of my Able product over the course of 2016, the current year we're in. So to make those changes, I'm going to select Recalculate. And what it's going to show us is our gross revenue. So this is the amount of money in sales we expect to make based on how many products we think we're going to sell. So really the spreadsheet is telling us that if we are to sell 1,000 products multiplied by the price we have assigned in the second column, this is how much money we can expect to come into our company just through the sale of our Able product. So after that, we notice that we do have the ability to calculate how much money we're spending to create this product, which is considered a variable cost. After that, this is what we have left over to pay for the rest of our expenses, so things like promotion and sales, since they're period costs. So this is like saying, after everything is said and done, we have $6.5 million left after paying for our promotion and sales budgets. Now, this is contingent on if our forecast is correct. So this is very reliant, or these fields are reliant on this number being correct. So hypothetically, if I put 1,000, I can potentially only sell 1,200, or I can sell 800. I mean, this is really an estimate. So this is dependent on what methodology I used to actually calculate this forecast. So keep in mind that this number needs to be accurate. We typically recommend using a worst case scenario so that you're projecting a relatively pessimistic outcome, just so you're not telling the system you're going to sell more than you actually will. But to kind of keep it short on the actual forecast, more of that content is going to be covered in the forecasting webinar. So from a very basic perspective, one way you can go about forecasting is by using the Capstone Courier, so we'll jump into that. So one of the most simple ways to forecast is to first calculate how much product the industry wanted to purchase last year. So keep in mind this report shows us what had happened over 2015. So if we take how many customers wanted products last year and we multiply that by the growth rate, we actually can determine how many customers want to purchase products this year in the current year for round one. So we'll go ahead and we'll do the math really quickly. So we have 7387 multiplied 1.092. So we're just multiplying by the growth rate of 9.2%. So in total, we have 8,066,000 people who want products. So having that information, we can determine what a sensible forecast might be when we factor in how many products we sold last year. So this is kind of why forecasting can be challenging, because what we sold last year isn't exactly the best indication of what we're going to sell in the future. But at this point, this is really all the information that we have at our disposal, because we don't know what strategies are going to be executed by our competitors. We don't know, what things might change this year. All we know is that what additions we're making to our product, what we're going to price it at, and we also know how the customers are going to feel about those changes, because we tell you this is exactly what your customers are looking for. So if we're to take this number and we actually multiply by, let's just say arbitrarily 13%, since we actually have the market share we had last year for our Able product, which is our traditional product. So if we find 13% of 8,066,000, that might be a sensible number for us to start with as our forecast, and we can adjust up or down depending on some of the actual changes we'll be making to our product. So the actual number, so if we're finding 13% of how many customers want product for next year, we actually have 1,048,000, which is actually not too far off from what we just threw in there as an estimate. So if we type 1048, click Recalculate, Now it's going to show us the gross revenue associated with selling 1,048,000 products. So at the very core of looking at the capstone courier, that's how you can at least formulate some type of forecast based on historical decisions. You don't want to kind of just guess and say, I'm thinking I'm going to sell 3 million products. That's not really based on fact. That's based more on just throwing out a number arbitrarily. So you don't really want to get used to making those types of decisions. What you should really be focusing on is how many products did you sell last year, anticipating customer movement or competitor movement, determining what strategy your competitors might be executing. What segments do you think they're going to tailor their products to, and what does that mean for your products? If you know that some of your competitors will be leaving the traditional segment, that means you might have more demand this year because their products are not going to sell as much if they're transitioning to a different segment. So definitely some things to keep in mind when you're doing your forecast. At the end of the day, it's really taking a look at the resources you have available to yourself and making the best judgment possible. And that will be covered more in the webinar on Thursday when we cover some more advanced forecasting techniques. One more thing I want to point out on the marketing decision page before we jump into some questions, or two things actually, is the AR policy. So again, more information is listed here. The accounts receivable policy is essentially saying, on average, how long do you want to give your customers before you expect payments? Like the bubble says, more generous terms produce higher demand, and you can also make this decision on the finance page if you don't feel comfortable making this decision here. So you'll notice that when you increase your accounts receivable policy, let's say we're increasing it to 45, this is like saying that on average, I'm giving my customers 45 days to pay me back for products. So you're kind of giving them a credit policy. It's credit terms for your customers. We click recalculate. You'll notice that the benchmark prediction actually increased a little bit. So this is kind of like saying, okay, with an increase of 15 days, how many more customers can I expect to purchase products? So definitely something you can fool around with. This is also a good way to manipulate how much cash you might have at the end of the year. From the most obvious standpoint, if you're giving your customers credit terms, that means less customers are going to be paying you immediately. So you might not have as much cash at the end of the year because you still have some accounts receivable shown in your balance sheet. So something to keep in mind. I'm just going to put that back to 30 just because I want to exemplify that. The last couple things I want to talk about are these graphs right here. So these graphs can be useful for kind of aiding decision making. Just keep in mind they are clickable, so you can jump into what decisions are costing you what, and you can also look at the cost structure like we mentioned too earlier, which will help to factor in with price. That is essentially it when discussing the marketing decision page, kind of from a basic perspective of decision making. Just to reiterate, as a marketing manager, if you're making marketing decisions, a lot of this information might be theoretically and conceptually easy to understand, because as a consumer, you know what awareness is, you might know what accessibility is, and you should know what price is. You're just assigning a price to your product, and again, you are making decisions for 3 of the 4 P's of the marketing mix, and then you're going to define how many products you think you're going to sell by product over the course of the next year. So again, this is a very important decision. It could cause some issues if you're actually just throwing in miscellaneous numbers like 3,000 or 2,000 if they aren't based on fact. So keep in mind that this is definitely something that you'll want to pay close attention to, because it can be very important with respect to how much cash you actually have at the end of the year. But that's pretty much all I want to cover for the marketing decision page. We can probably jump into some questions if we have any. 1 second, let me see. Also keep in mind, so if you do have a question, feel free to type them in the question box. So I know that there's a little red arrow kind of in the upper right-hand corner of your screen. If you expand that, you can actually type some questions in. So a couple questions we have here is, how will my demand be impacted by my marketing decisions? So we kind of touched on this. As I mentioned, when you assign a price, you're assigning also a promotion budget and a sales budget. But really what you're doing is you're manipulating your customer survey score, which is something that will be touched on during the webinar on Thursday. But if we jump into Capstone Courier and we open up, let's say, the traditional segment, you'll know that on the bottom where it says top products in the traditional segment, you have this December customer survey score. So the survey score tells you how well, or how not well for that matter, your customers actually like your product. So at the beginning of the game, everyone is created equal. Every primary traditional product has a score of 18 out of a possible 100 points. So those points are coming primarily from the customer buying criteria. You'll notice that the importance percentage always adds up to 100. If you have a perfect product, you're gonna receive 100 points. So these four things actually are factored into what your customer survey scores. But on top of that, this is something we mentioned last week, I believe, during the webinar, that your accounts receivable policy also is factored into this number, and your promotion budget and your sales budgets are also factored into this number too. So if we wanted to read this, let's say we're looking at the promotion and the awareness for, the awareness and the accessibility for the Able product. This reads as 55% of all available customers are aware that my Able product exists. Of those 55% of total customers, 54% of which can access my product and communicate with my brand. So you can't really communicate with a brand or access a product if you don't really know it exists. So that's kind of the importance of actually driving up your promotion budget or your sales budget, because the more people who know about your product, and of which more people that can interact with your product, you're going to have a higher likelihood of selling more product. So again, this is something you should consider depending on your strategy. So if you're taking the perspective of a differentiator, differentiators essentially create demand by creating great products in R&D and also having relatively aggressive promotion and sales budgets. Whereas a cost leader is going to compete primarily on costs, so they reduce their costs, and they're going to pass some of those savings on to their customers. So from the perspective of a cost leader, you might not be so interested in really boosting your awareness and your accessibility as high as that of a differentiator would. So going back to the initial question is, how will demand be impacted by my marketing decisions? Well, we know that price is something your competitors or your customers care about. We also know that the awareness and accessibility is important to pay attention to also. So keep that in mind. It is dependent on strategy. So hopefully that answers to help answer your question. Here's one question we have. Suppose long-term debt maturity is in this year, and is it better to retire those debts now if market value is less than face value? I do agree that's a great question, but that's more of a finance question. I would definitely give us a call, our support line 877-477-8787, just so we can actually answer that question to the best of our ability, and we're not taking up time discussing finance questions when we're looking at marketing. So the next question we have is, can we trust the marketing area's benchmark prediction? So that's also a great question, and the answer is yes and no, depending on what you're using it for. So this number should never be used for forecasting, and the reason why I say that is because this number is calculated based on comparing your product specifications to a very subpar product. So this number might be overinflated. This is like saying you're going to sell 2.1 million products this year because we're comparing your actual product with fake competitive products. Realistically speaking, your products are going to be the way they are, but your competitors' products are not going to be as bad as the system portrays them to be. So using this number, you do have the likelihood of actually overinflating your forecast. What this number is good for is kind of observing the change or the boost based on your decisions. So let's say, for example, we increase our price to $29. Watch how this number actually moves. It's going to move down since technically all customers are going to want the same product for cheaper. We'll take a look. So you'll notice that this number actually went down a little bit. So not by a lot, but it still went down. So that's where this number is actually useful. This number is useful for kind of determining the elasticity of the marketplace. So it's like saying, based on my decisions, whether it's price, promotion, sales, or AR, AP, you can actually determine the impact of your decisions by throwing them in here and observing how much change you're expecting. So if you do mess with your promotion budget or your sales budget, you can kind of do a break-even analysis and say, okay, well, is spending an additional $100,000 in my promotion budget, is that justifiable to see in my sales? Because this number is really just the algorithm telling you, okay, how much of a change would you see if you were to adjust some things up or down? So again, if we're going to mess with the AR policy, let's say we move it to 45, this should have a desirable impact on the benchmark predictions. So you'll notice this number goes up. So there you go. So just under, I think it's like 75, you can technically add the change onto your forecast. So if you notice there was a 75 unit change, you can add 75 units on your forecast because you know your AR policy is going to impact your sales just like your marketing decisions, things like price, promo, and sales. So that's a great question. Hopefully that helps to clarify. If you want some more clarification on how to use this, then definitely feel free to give us a call or shoot us an email. We'd be more than happy to kind of break it down a little bit more for you. Another question we have is how can I calculate my intended awareness and accessibility? So this is definitely something we talked about. I would definitely reference these eyes inside of the spreadsheet. So it says that you will lose 1/3 each year as customers forget the product. So naturally, if you don't keep blasting customers with some type of marketing material, then they're probably going to inevitably forget about your product. So this gives you an actual example. If your product had 60% awareness last year, which will be shown in the Capstone Courier or Foundation Fast Track, you will lose, it would fall to 40% because you're losing 1/3 of 60%, which is 20%. And then if you spend $0 to promote the product, you're only going to have that 40%. So like we mentioned earlier, you're building that budget back up. So it's like saying your first million is going to increase awareness about 22%. The second million is going to add 23%. And the third million only gets another 5%. So diminishing returns do apply after the second million, but you still receive a small benefit for entering 3 million. So this gives you a way to calculate what your awareness and what your accessibility will be, just given the basic rules of the software, right? So every year you do lose 33% of your previous awareness or accessibility, and then every expenditure is actually going to add back on to that reduction of 33%. So definitely something to pay attention to, and these eyes are very helpful because they tell you, they give you an example, and they also tell you how much money is going to actually re-add that money back. So definitely something to pay close attention to. Last question we have at this point is about new products. So when I introduce a new product, will I have to add a promotion budget to it and sales budget? So the answer to that question is it really depends on what you want to do. So with the introduction of a new product, naturally there's some hype, right? So we know that when Apple comes out with a new product, people know about it. It's no surprise. But they kind of get a 25% boost. So similar case applies to this is your promotion budget is automatically going to be at 25% when a new product comes out for the first year. After that, the same rules apply. So having said that, if you are a differentiator, you're probably going to want to spend more money in your promotion or your sales budget just to kind of get the word out there, just to improve your distribution channels. But this is really contingent on the strategy too. I mean, more likely than not, it's a good idea to be investing in your promotion and your sales budgets during the year your product comes out, because that'll improve the likelihood that you're going to sell more product. So definitely something to keep in mind. That's a great question because we do see a lot of student teams creating new products over the course of the 8-year Capstone or Foundation simulation. But definitely be mindful of that when a new product does come out. Be sure to promote that and to add a sales budget so you increase your likelihood for sales. Looks like we have no more questions. We are just about out of time. Before we end today, I want to show you all where you can enroll for future webinars and also where to watch some of the recordings where this one will be placed also. So we're going to go ahead and we're going to log out, go back to the CapSim homepage. We're going to go to the Events tab at the very top. And then we are going to scroll down and click Webinars. So you guys will want to select the Student Webinars. So this is where you can actually watch the recordings from the previous webinar. So today we talked about marketing, more advanced decision making. It's called the Spotlight Your Brand. This should be up within the next day or two. Typically it takes 24 to 48 hours, so check back sometime in the next couple of days for this webinar if you want to watch it, take some notes. But this is where you can enroll for future webinars also. So for Thursday's webinar, we mentioned that we're going to be discussing more advanced forecasting decisions. This is exactly where you can kind of take a look at where to enroll. So we click on Predict the Future. You'll have a field to fill out, and that'll send an email. You'll get some reminders too on when the webinar takes place. So definitely a good tool to know of. Last thing, I will show you contact information in case you have any specific questions that you want to direct to our support representatives. So underneath it, contact us. If you're inside of North America, this is the best number to reach us at, 877-477-8787. Otherwise, if you're outside of the U.S., you can give us a call toll-free at 312-477-7232, or you can shoot us an email at support@capson.com. That about sums it up. Thank you for attending. We hope to see you at future webinars. Have a good one, guys.